Thanks for being with us. Joining me now is Manish Sonthalia of Emkay Investment Managers. Manish, great having you as always. Thanks for taking the time out. Manish, a lot of talk, as always, about whether we are stretched, and we've looked stretched for God knows the last 12 to 18 months, and we've still continued to move higher. How are you thinking about the market currently?
Right, Neeraj, the conundrum is huge liquidity, and the problem is earnings and valuation. So you got to pick and choose within the entire universe where there is a comfort in terms of earning and valuation, and those stocks will have decent inflows into them. So I was just doing some numbers. India has some 57 sectors, and if you take the mean valuation of each of these 57 sectors, I mean, hardly 10% or 5 or 6 sectors would be at some comfortable valuation zone compared to the last 10 years mean valuation. The rest 50 sectors would be trading at higher than 10-year average mean valuation. So that is the state of things as we speak. And SIP flows, which is basically a smart institutional money, keeps piling on 20,000 odd crores SIP flows. I mean, as long as that continues, you got to pick and choose between the broader markets. India has a long runway to go from here. Obviously, the medium-term outlook is definitely bullish, and even the long-term outlook. But problems in individual sectors will remain for the near term. That is where stock picking will come into play. So that's how things are. Definitely, I think if you don't have some very nasty macro surprises or regulatory or policy surprises on the negative side, all dips will be bought into. I mean, India is turning, as somebody said, from a country of savers to a country of investors. I mean, that's unlikely to be reversed very soon.
Yeah. Probably these things don't get reversed so easily, and maybe for the right reasons, Manish. Investing is better than maybe spending away all of those saving as well. I just wonder though, Manish, you make a very valid point about how just 5 out of 67, if I'm not wrong, I heard you correct.
57.
57. 5 out of 57 sectors trading at average valuations, but the ones which are trading at punchy valuations, some of them are promising or showing a runway for growth which is long as well. So how do you then therefore do bottom fishing as well, even if you are bottom up? Because I'm just saying that a stock will not outrun the sectoral growth in a disproportionate fashion for a long period of time, right? You will go bottom up, but you will still have to have the tailwinds for the theme. Where are those themes where you might be comfortable currently?
So obviously, capital expenditure, railways, defense, infrastructure, these are all important themes in India's context for the next 5-10 years. I mean, the India manufacturing story per se rests on this. So 5 themes which we have also talked about in the past is your consumption, is your financialization of savings, is your energy transition from fossil to renewables, your India manufacturing story, and the digitization, artificial intelligence taking over. So these 5 themes will stand in good stead. Within these 5 themes, one needs to find stocks where you are early in the game, where the market has discovered it and priced it more than perfection, is where the opportunity lies. And mind you, there will be newer companies which will come to the markets every now and then. And because most of the sectors and stocks are well discovered and priced to perfection, given the liquidity flows, I think new companies coming into the markets, you may have a certain advantage in getting into these stocks slightly early.
Point well noted. Okay, the topical point, Manish, I want to start off with a few. Actually, let me first talk about a follow-up to the question that you made. And we have this chart here which speaks about, well, the one thing which will be required at any point of time in a capex cycle, which is power. And let's just pull up this annual power demand in India trend. This is from a report from Kotak Institutional Equities. And as you can see, after a dip in 2021 for obvious reasons, it has trended higher. Even if you argue that 2023 had a large number in terms of growth, the growth in 2024 isn't quite small. And if there were numbers projected ahead, I'm sure those numbers would have looked strong. Manish, it's a theme that has come back with a bang, power. And across the whole ecosystem, generators, distributors, equipment suppliers, financiers. So if you're trying to play capex, is power still looking relevant, or are the valuations too stretched?
Now, I think the point to note out here is that India was underinvested in energy during the demon days and the run up to your COVID. Given the growth that we are having, India really didn't have the energy security that we needed to achieve this sort of a growth. So power is obviously one of that. And within that, I think all aspects of power, and if you are to achieve a 6-7% real GDP growth, I mean, you have a long runway for all segments of power. And within that, it will be generation, distribution, transmission, energy storage, renewables, and within renewables, solar, wind, cables, conductors, transformers. I mean, you name it. So I think the entire value chain will have a long runway for growth for the next 5-10 years. Now, within that, if you compare where the value is, I would strongly believe that the value lies in the public sector units at the current valuation. So let's take a case of transmission. Many of the private sector counterparts are trading at many times multiples of the largest power transmission company in the PSU space. So you have one such opportunity, or let's say a thermal, or let's say, the guys who are making the equipments. So there's a very big disparity in entire value chain in the private sector and the public sector. Yes, I understand there will be some discount in valuation, but if the growth is out there and bulk of the growth is going to come to a few players because they are so large that you can't ignore them, then obviously there is where the value lies. And you are absolutely correct that, the power, it's not the end of the road as yet. Many of the private sector companies are trading at lofty valuation. They can go through some time correction. Many of the companies are trading at 60, 70p. Probably you would be discounting the next 5 years of earnings. I mean, you can't have a very stretched near-term valuation. Markets will look forward into the future, maybe in FY26 numbers, FY27, but markets can't be looking at FY30 numbers just yet. So the big theme stays, but within the valuation set, I think PSUs have a higher margin of safety in the current sector.
Okay. Speaking of PSUs, Manish, the recent last 3-4 days, one of the sectors that has come back from the brink where valuations might also be good is our energy stocks, and not power, but upstream oil, etc. A lot of people have turned constructive there. Oil prices are not quite buckling down, though not quite flaring either. Any thoughts on oil upstream, or maybe even some of the city gas distributors or oil marketing companies?
So I think this sector is very dependent on policy initiatives and regulations and announcements. So valuations are absolutely comfortable. And mind you, if we talk about the upstream oil companies, they don't get the market realization of the Brent that we see on a day-to-day basis. There is a huge tax element that is out there, and they get a discount. But even after accounting for all of that, I mean, the valuations are extremely comfortable, I would say. And given the high dividend yield on all of these companies, I would think if you're looking for one of the 5 sectors in those 57 sectors is basically energy. And mind you, oil prices have not, petrol and diesel prices have not changed over the last 2 years. Still, these guys are making normal margins. Let's say a GRM of $2-3 and a marketing margin of $4-5 on a blended basis. 5p, 7%, 6% dividend yield, and how can you go wrong? So there is a deep value as far as the energy space is concerned. If we talk about CGD companies, obviously the markets are banking on the fact that natural gas is going to come under GST. If that happens, then and obviously, the expectation is that maybe in the budget or even after that, you'll have the entire pipeline distribution of natural gas, cost. And the companies obviously are going to benefit because there's an input credit that is going to be allowed. You have the city gas distribution companies where once you actually market the natural gas, well, whatever costs are being paid by the consumers, they can be taken as an input credit. You have the LNG terminal, regasification guys who actually import gas, regasify it, and sell it. Obviously, the costs which are included in the regasification will be allowed as an input credit for some of these companies. So I think this sector, the CGT, apart from the deep valuation, which some of these names were, let's say 3-4 years back, have got normalized now to somewhat rational valuation, is now banking on the fact that natural gas comes under GST, and if that happens, then obviously that's going to be a boost for the margins for each of these players in the entire value.
Got it. Okay. Okay. Last question, Manish. The sector in focus, autos, with the price cut that M&M had to take, is this the start of, is this pointing towards some demand stress and a start of maybe a prolonged price cut cycle?
The consumer discretionary demand has been soft all across in the first quarter. So autos obviously being a discretionary spend is no exception. Having said that, on a YOY basis, first quarter numbers for the entire auto pack will look fantabulous. But if you were to project the demand going into the future, what was expected, a normalized demand growth of 5%, for the four-wheelers, pass cars, and two-wheelers was around 6 to 7% volume growth for FY25, and a muted demand for the HCV space and tractors. What is happening right now, as we read, is that there's an inventory pile-up in the pass cars to the extent of 2 months of inventory. And obviously, once that happens, as we have seen in previous cycles as well, that you have to give discounts, and you are starting to see players start to lower the prices because you have got to clear your inventory. So margin tailwind going out into the future is not going to be there. We expect that the second half of the year, whatever expectation of volume growth is likely to play out. In the interim, there can be some compression in valuations because valuations are rather full, given the earnings momentum that we're likely to see. More bullish on two-wheelers, and within the two-wheelers, the premium segment of the motorcycle, which is 125 plus or 150 plus, going up to 350, 400 cc. There, I think the premiumization trend, if you were to look at from a medium-term perspective, looks very, very sound. And that opportunity is going to play out, and you have the likely players, 2 or 3 of them. You have international players like Harley and, Triumph also come through. Obviously, looking at the premium end of the motorcycle, starting to look very good as far as the opportunity set is concerned in terms of growth. HCV, you got to wait and watch. Many of the players are alluding to the fact that they see a growth for FY25 as opposed to a flat growth. So, all of these things are so unpredictable, let's say 6 months back, and unfolds to you right in the place. So HCVs, two-wheelers on a positive, pass cars is a wait and watch, hoping that monsoons is going to be good, rural recovery will play out in second half. You'll likely see some growth. In the interim, maybe, underperformer vis-a-vis two-wheelers.
I think that sums it up so well. Pass cars or passenger cars are a wait and watch. Selective views on two-wheelers, and HCV, where Manish is maybe a bit of an outlier relative to what some of the others are. A lot of other people are negative on HCVs as well. So, but that's the market. It takes both a buyer and a seller for the stock to do what it does. Manish Sonthalia, take a moment to thank you for joining in today and giving us your thoughts.
Thank you.
Really appreciate your time.
Thank you.
Well, as we speak, the markets are down and have lost quite a bit of ground from the highs of the day at circa 10:30. But select names, particularly from the auto component space as well, are not doing too badly. So that's a sector you want to watch out. Sona, BLW and a few others have had a decent move in the session today. So keep an eye out for some of those. With that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.